Hello, scholars. My name is Joseph Ejike Oji. In this lecture, we focus on two things, leverage and alpha, as they relate to foreign exchange transaction and trading. I think what I mean by that is that we'll be focusing on leverage and alpha as they relate to foreign exchange trading and investing. So, what's leverage? Well, a simple way to explain leverage is that it is a method of leaning on something to gain an advantage. So, when you lean on something to gain advantage, then you are taking making that in your leverage. So, when it comes to forex trading, leverage is connected to loan. Okay, so in other words, in forex trading, you leverage by using borrowed money to magnify the size of the return on your investment. So leverage is what attracts most speculators. When you look at forex trading, foreign exchange transaction, the profit that are made from currency differentials is very little. When you look at the difference, it might be 1 cent difference between US dollar and European euro, and so on and so forth. So different currency, the kind of difference gain is so small that the way you can actually make a good gain is by increasing the size of your transaction. So that's why where leverage comes in here. It helps you to magnify the amount of transaction and in turn magnify the return on your investment. So but leverage can have good side and bad side. So it is a double-edged sword. Example, most foreign brokers offer their clients 50 times leverage on their major currencies. So this means that with $2,000, a trader can buy up to $100,000 worth of investments. So so let me show you how it works. Okay, because I believe in giving examples. Example is better than precept. Suppose that you have $2,000 you want to invest. So and then this is how much you have to invest in a currency trading or in a kind of currency. You want to use it to buy and sell currency. Okay, let me put that through. Now, so you bought a currency. The size of your investment is $2,000. So let's look at this trade without leverage. Suppose the investment value increased by say 2%. For example, let me make sure you're seeing this. Okay, let me make sure you're seeing this. Okay, good. I think you're seeing this. Suppose the size of your investment increased by 2%. In that case, in that trade, your gain is going to be $2,000, okay, times 1.02, okay, because say 2% increase. So this 100% represent this investment as a size. So 1.02 because it increased by 2% minus the amount you invested, which is $2,000. So let's go and put this in the calculator and see how much you make at that particular point in time. Okay. So you have 2,000 times 1.02, okay, minus your investment amount, which is $2,000. So this is this represents the amount you invested plus the increase, the minus the so minus the your capital, the amount you invested, so that you can get the profit, which is $40. Let's say that this increase was caused by an announcement by the Federal Reserve chairperson that they will increase they will raise the interest rate for borrowing. That can cause currency to go up. So you make a profit of $40 at that particular point in time. So that gives you $40 profit. Okay, but $40 profit is not what you somebody who is trading as a trader. You want to make money, right? So that's when leverage comes. Now let's examine this same trade with leverage. Now suppose you use leverage and you are like I mentioned here in my discussion, most forex brokers will offer their client 50 times leverage on their major currencies. So let's say that you are trading with one of the brokerage firms, their online accounts. You have an online account, let's say Fidelity or any of the brokerage firms, discount brokers that you are using to trade. There are many times. I mentioned this, some of them in my previous lecture. So, and then they give you 50, the amount you have is $2,000. So they'll give you 50 times 2,000 a loan. They multiply that amount you have by 50, which is $2,000 times 2,000. That'll give you 50 times 2,000. So have 50 times 2,000, $100,000. So they give you, the way they calculate the loan, the maximum amount of loan they can give you is by multiplying by 50. Some might say 30. Some might say, depend on the discount broker that you are using. It's 100,000. So this time around, that means you are trading, you borrowed 100,000 to trade, because you have 2,000, they give you this amount to trade as a loan. Of course, they will charge you some interest. Now, you apply this. So instead of trading with 2,000, you're trading with 100,000. So your gain now becomes, okay, when they assume that the value of the investment rise by 2%, like the previous example. So your gain now becomes 100,000 times 1.02, okay, cost minus 100,000 of the investment. Okay. Now let us go and examine this. Put it in the calculator. So we go to the calculator and then clear this. So you have 100,000 times, make sure I'm seeing this. Yep, I've seen it. So 100,000 times 1.02. That's to show the increment. 1.02. Okay. Minus 100,000. Your capital invest. Okay. Okay. So you made $2,000. Okay, $2,000. So basically, you made all your capital back. See? Now you can return the loan. Okay, with a little interest. Maybe they charge you 3%. So you have 3%. You pay. You give them the 100,000 back. Okay, plus a little interest. So instead of making a gain of $40, you make a gain of $22,000. When you subtract the interest, let's say $200 interest, making $1,800, $1,800 is much better than $40. Then now you have paid your money back. So you give them the $100,000 back plus the interest of $2,200, so that you have a balance of $1,800. See, in other words, you give them $100,000 back, okay, minus $200 or whatever amount they charge you for interest. So at the end of the day, you have $1,800 instead of $40. Now, that is, you can see how leverage works. But like I said, leverage is is a double-edged sword. So instead of your value of investment increasing by 2%, suppose that instead it decreases. Maybe that the Fed made a statement, okay, that they're not going to raise interest rates, and that this caused the value, the dollar to fall in value by 2%, for example. In that case, the leverage will work against you. Instead of making money, look at what you're going to have. Now, 100% minus 2% is 98%. So what you're going to have as a gain will now become gain equals $100,000 times, like I say, 100% minus 2% loss is 98%, which is 0.98. Okay, minus 100,000. And that would be putting this in a calculator. We're gonna have we got 100,000 times 0.98. So you'll be losing. You have a loss of $2,000. So let me put it. You have a loss of $2,000. Negative $2,000. See? In that case, now most of this money we borrow from your broker to fund this trade. They usually borrow overnight. That means you borrow them today to make a trade, then the next day you are required to return it. So once you make a loss and next day you don't even return the money, you will have what you call margin call. You call it a margin call. They need their money back. So if you can't pay it, they have the right to go and take your any amount of money that is being reserved in your trading accounts. So you can see how leverage works. If everything goes well, you can magnify your return. Okay. So I believe that you get the point when it comes to leverage. So so the problem that is that currency can move against you just as easily as it can move in your favor, like I explained in my example. So which means that the fact that you are giving the fact that you are giving that the broker is offering you that much leverage doesn't mean that you have to use it. You have to use it only if you are sure of making money from it. So usually those that want to make money, in fact, want to survive in currency trading, like I explained in my previous lecture, it's a very volatile market. So you can see people start with $2,000. Within a few days, they lost the whole money. So you have to be very, very disciplined and careful. And those that survive it usually trade with only, I'll put it this way, the professional traders who survived in the forex market will usually not risk more than 5% of their accounts on any one trade. Don't use more than 5% of your account in any one trade. So that means if you have only $2,000 and using only 5%, that would be very little. So again, the profit margin in forex trading is so small. So you need to have a high volume trade before you can really make a big one. So in as much as that, even if you have that leverage, you have to be used with care. Very careful. You have to be very careful when using it. Which leads us to the next topic in our discussion, which is alpha. Simply put, alpha is considered, of course, it is a return on investment, but it actually gauges the performance of an investment against a market index or benchmark that is considered to represent the market movement as a whole. So, in other words, alpha is the excess return that a manager can make above and beyond a benchmark index like S&P 500 or any risk-free investments like treasuries. Let me show you what I mean by those market index. So those market indices I think I'm going to open Yahoo Finance to figure this out. I hope you can see it. Okay. So you can see the index. I can see S&P 500 track the 500 largest industrial corporation in the United States. They still do that manufacturing, industry, production companies in the US track them. This one's NASDAQ tracks technology companies like Amazon, Facebook, and so on and so forth. Amazon, Facebook, Microsoft, Apple, so they track them. Then the Russell index. So there are many of them. So if the fund manager that manages the fund, your fund, if the performance cannot, if its performance is higher than the performance of any of these indices by 20%, that means 20% is the alpha. That's what I'm trying to say. So it's a performance that's above the index. So in other words, excess return on investment related to the return on any benchmark index. So alpha is basically how managers earn their keep. Because why would somebody invest in a fund and pay, when you invest in a fund, you pay what they call management or performance fee. That's how the fund managers get their money. So why put your money in a fund if all that they can do is to earn the same return or less than the S&P 500 that even you can make by yourself? So if the manager can make alpha all the time, he or she will attract a lot of investments. But if it doesn't, if you can make only just the same return as the S&P 500 or any of the index, or even less than that, so why put your money in the fund? You want them that if they can make it, that means you yourself can even make up to that by yourself. So investors and traders turn to the forex because of the desire to earn, additional alpha. So as what alpha is. Now we round up with discussion with what we called investors and speculators. Now, what is the difference? Well, the main difference is this: that investors and traders take calculated risk as they attempt to profit from the transaction they make in the market. So an investor might be saying, okay, want to buy a stock of Walmart stock. Before they do that, they look at the Walmart, their fundamentals. Like they look at the balance sheet, income statement, and say, okay, this is a good company, and they have a high chance of making profit. They can then invest. But speculators actually do the opposite. As a matter of fact, the difference between investors and speculators is the level of risk undertaken. So the level of risk undertaken in a transaction is the main difference between this investor and speculator. So investors take low risk. So that means they look at the fundamentals. It's okay. We are not expecting this. We expect this company to increase in a few years, in value in a few years. They invest. But speculators they invest in high risk assets. For example, last week the S&P, the market was down because of so many negative news. So a speculator might bet that the market will be down, and then he'll buy a very risk investment like options, binary options, or any kind of options or contract that market will die, will go down. So you can buy a put option. So if the market goes down, they make a lot of money. But if the market moves, like last week, sometimes it was down, and sometimes it was up, they lose money. Unlike investors who just buy the company, even if the market is moving up and down, it will be still be trending up. Within a year or 2 years, it will go high. But speculators are short term. This week or this month, market will be down or will be up. If it's not up, they lose money. They lose all the money they invested. So whenever a person spend money with the expectation that the endeavor will return a profit, then they are investing. So uh, the person spending money that's and expecting that they make profit. The undertaking basis, uh, the investor bases their decision on a reasonable judgment made after they make what they call a thorough investigation of the soundness of that asset has. So they make a thorough investigation to make sure that it has a good probability of success. Now, but speculating, in that, what they do is, bet against the market, or buy something that is very risky. But the good thing that when they make money, the money is really huge, big money. So that's that big money that we made. That is the thing that motivates them to spend money on the asset, even though the asset shows a high probability of failure. But for some reason, they are convinced that it will go the other way. When they look at the profit they will make, they'll invest there. So when it comes to speculating, the success of failure depends to a very large extent on chance or on uncontrollable forces of events. Now, investors usually buy stocks, bonds, So this will help them to generate a satisfactory return on their capital by taking an average or below risk investment like stocks and bonds. But speculators, they're looking for abnormally high return. So they usually buy assets like futures, options, short selling trading strategies they use to make their own money. This is I hope you enjoy my lecture tonight. Thank you for listening, and I will see you in my next lecture. Bye-bye.